Interest rates are like the price tags on borrowed money. They determine how much extra you'll have to pay back in addition to the amount you initially borrowed. Just like when you buy an item and see a price tag, interest rates give you an idea of the cost of borrowing money. When you take out a loan or use a credit card, you're essentially renting money. This means you're using someone else's money for a period of time, and in return, you agree to pay a fee for that service. This fee is what we call interest. Whether it's for buying a car, a house, or even just making everyday purchases, understanding how this works is essential. The interest rate is the fee you pay for that privilege, usually expressed as a percentage. For example, if you borrow $1,000 at an interest rate of 5%, you'll pay an additional $50 over the course of a year. This percentage can vary widely depending on various factors, including your credit score, the type of loan, and the lender's policies. Think of it as the cost of borrowing. Just like you wouldn't rent an apartment without knowing the monthly rent, you shouldn't borrow money without understanding the interest rate. This cost can add up over time, especially if you're making minimum payments on a credit card or have a long-term loan. Higher interest rates mean borrowing is more expensive. When interest rates rise, the cost of loans and credit increases, making it more challenging to afford big-ticket items or manage debt. This can lead to financial stress and make it harder to achieve your financial goals. Lower rates make it cheaper. Conversely, when interest rates fall, borrowing becomes more affordable. This can be a great opportunity to refinance existing loans, take out new loans for major purchases, or pay down debt more quickly. Lower interest rates can provide significant savings over time. Understanding interest rates is crucial for making smart financial decisions. Whether you're planning to take out a loan, use a credit card, or invest your money, knowing how interest rates work can help you make informed choices. It's always a good idea to consult with a financial advisor to understand the best options for your specific situation. By being informed, you can avoid costly mistakes and make the most of your financial resources. Central banks, like the Federal Reserve in the United States, play a crucial role in managing interest rates. These institutions are pivotal in maintaining economic stability and ensuring that inflation does not spiral out of control. The Federal Reserve, often referred to as the Fed, uses various tools and strategies to influence the economy, with interest rates being one of the most significant. They don't set rates for everything, but they influence overall borrowing costs. This means that while the Fed doesn't directly control the interest rates on your mortgage or car loan, its policies have a ripple effect throughout the financial system. When the Fed adjusts its rates, it sends signals to banks and financial institutions, which in turn adjust their own rates. This can affect everything from personal loans to business investments. One of their main tools is the federal funds rate, which is the interest banks charge each other for short-term loans. This rate is crucial because it influences the supply of money in the economy. When the federal funds rate is low, borrowing becomes cheaper, encouraging spending and investment. Conversely, when the rate is high, borrowing costs increase, which can slow down economic activity. By adjusting this rate, the Fed tries to keep inflation in check. Inflation, the rate at which the general level of prices for goods and services rises, erodes purchasing power. The Fed aims to maintain a balance where inflation is neither too high nor too low. If inflation is too low, it can lead to economic stagnation. If it's too high, it can reduce the value of money and create uncertainty in the economy. When inflation is high, they raise rates to cool down the economy. This makes borrowing more expensive, which can reduce spending and investment. As a result, demand for goods and services decreases, which can help bring prices down. However, this approach is not without its challenges. Raising interest rates too quickly or too high can lead to a recession, where economic activity slows down significantly, leading to job losses and reduced income for many people. Therefore, the Fed must carefully consider the timing and magnitude of its rate adjustments to avoid causing more harm than good. Conversely, when the economy is sluggish and inflation is low, the Fed may lower interest rates to stimulate growth. Lower rates make borrowing cheaper, encouraging businesses to invest and consumers to spend. This can help boost economic activity and create jobs. The goal is to find a sweet spot where the economy grows steadily without causing runaway inflation. In summary, the Federal Reserve's management of interest rates is a delicate balancing act. By carefully adjusting the federal funds rate, the Fed aims to control inflation, support economic growth, and maintain financial stability. This process requires constant monitoring of economic indicators and a deep understanding of the complex interplay between various economic factors. Through its actions, the Fed strives to create a stable economic environment that benefits everyone. Mortgages, loans used to buy homes, are highly sensitive to interest rate changes. Even a small increase in rates can significantly impact your monthly payments. For example, a 1% rise on a $300,000 mortgage could increase your monthly payment by hundreds of dollars. This can make homeownership less affordable, especially for first-time buyers. Personal loans, often used for debt consolidation or unexpected expenses, also become more expensive when interest rates rise. This is because lenders factor in the increased cost of borrowing when determining loan terms. As a result, you might find yourself paying more in interest over the life of the loan. This can make it harder to achieve your financial goals. Section 5. The shrinking wallet. How interest rates impact disposable income. Rising interest rates can put a serious dent in your disposable income, the money you have left after paying taxes and essential expenses. As your debt payments increase, you have less money available for other things. This can force tough choices between spending, saving, and investing. In extreme cases, it can even lead to debt accumulation. Section 6. From cars to college. The ripple effect on major purchases. The impact of rising interest rates extends beyond mortgages and personal loans. It affects financing for other major purchases like cars and education. Higher rates mean higher monthly payments on auto loans, making new or used cars less affordable. Similarly, student loan interest rates can make financing education more costly. Section 7. Credit card debt. A slippery slope when rates climb. Credit card debt is particularly vulnerable to interest rate hikes. This is because credit cards typically have variable interest rates, meaning they fluctuate with the market. When rates go up, so do your minimum payments and the total amount of interest you owe. This can quickly turn a manageable balance into a major financial burden. Section 8. The long view: interest rates and your financial future. Interest rates are a fundamental aspect of the economy that can have far-reaching effects on your personal finances. They are the cost of borrowing money and the return on savings, and they play a crucial role in shaping the financial landscape. The impact of interest rates goes beyond immediate expenses. When interest rates rise, the cost of borrowing increases, which can affect everything from mortgage payments to credit card debt. This can lead to higher monthly payments and reduced disposable income, making it harder to manage day-to-day expenses. It affects your long-term financial health, influencing your ability to save for retirement, invest wisely, and achieve financial goals. For retirees, higher interest rates can mean better returns on savings accounts and fixed-income investments, providing a more stable income stream. For younger individuals, understanding how interest rates impact loans and investments is key to building a solid financial foundation. Higher interest rates can make it more challenging to save and invest effectively. When rates are high, borrowing costs increase, which can deter individuals from taking out loans for major purchases like homes or cars. Additionally, higher rates can lead to lower stock market returns, as companies face higher borrowing costs and reduced profitability. While lower rates can provide opportunities for growth, lower interest rates reduce the cost of borrowing, making it easier for individuals and businesses to take out loans and invest in growth opportunities. This can lead to increased economic activity, higher stock market returns, and greater potential for financial success. Understanding these dynamics is crucial for making informed financial decisions. By staying informed about interest rate trends and how they affect different aspects of your finances, you can better navigate the complexities of the financial world. Whether you're saving for retirement, investing in the stock market, or managing debt, a solid grasp of interest rates can help you make smarter choices and achieve your financial goals. It's also important to consider the broader economic context when thinking about interest rates. Central banks, such as the Federal Reserve in the United States, play a significant role in setting interest rates based on economic conditions. They may raise rates to combat inflation or lower them to stimulate economic growth. Understanding these policy decisions can provide valuable insights into future interest rate trends and help you anticipate changes that may impact your financial plans. Working with a financial advisor can also be beneficial in navigating the complexities of interest rates. A professional can help you develop strategies to manage debt, optimize savings, and invest wisely in different interest rate environments. They can provide personalized advice tailored to your unique financial situation and goals, helping you make the most of your money regardless of the current interest rate climate. Diversification is another key strategy in managing the impact of interest rates on your investments. By spreading your investments across different asset classes, such as stocks, bonds, and real estate, you can reduce risk and improve your chances of achieving stable returns. This approach can help you weather periods of high or low interest rates and maintain a balanced portfolio that supports your long-term financial objectives. Ultimately, understanding interest rates and their effects on your financial future is essential for achieving your financial goals. By staying informed, seeking professional advice, and employing sound financial strategies, you can navigate the ever-changing landscape of interest rates and build a secure and prosperous future for yourself and your family. Section 9. Practical tips for navigating a high-interest rate environment. In a high-interest rate environment, it's essential to be proactive about managing your finances. This includes creating a realistic budget, prioritizing debt repayment, and exploring strategies to increase your income. By taking control of your finances, you can minimize the negative impact of rising rates and work towards your financial goals. Section 10. Budgeting basics. Taking control of your finances. Creating a budget doesn't have to be complicated. Start by tracking your income and expenses for a month to understand where your money is going. Then identify areas where you can cut back on spending and allocate more towards debt repayment or savings. Section 11. Exploring debt management strategies. If you're struggling with high-interest debt, explore debt management strategies like the debt snowball or avalanche methods to regain control. These methods involve prioritizing debt payments based on interest rates or balances to help you pay off debt faster and more efficiently. Section 12. Making informed borrowing decisions. Before taking on new debt, carefully consider the interest rates and terms. Compare offers from multiple lenders to ensure you're getting the best possible deal. If possible, try to delay major purchases until interest rates are more favorable. Section 13. Conclusion. Weathering the storm of rising interest rates. Rising interest rates can be a source of financial stress, but understanding their impact and taking proactive steps to manage your finances can help you weather the storm. Remember to budget wisely, prioritize debt repayment, and make informed borrowing decisions to protect your financial well-being.